Hi there everyone, Lee from Setters Property Finance here. Today we're diving deep into the recent RBA decision and what it means for all of us navigating the mortgage and property market. Before we get started, if you haven't already, please make sure to hit the like button, subscribe to our channel and don't forget to turn on notifications. So, let's get right into it. In our rate update video last week, we talked about the RBA's decision to keep the cash rate target unchanged at 4.1%. In today's video, let's go into more detail about the current state of things and what we should be looking out for. First, let's address the RBA's stance on inflation. As we know, inflation has been the key driver behind recent cash rate rises. We can see from the RBA's inflation graph, it seems to have peaked and is on the decline. We are currently at 4.9% this month, which is still relatively high, however much better than the 7.8% back in December. The RBA's projections show that we can expect inflation to gradually return to the typical 2 to 3% range by late 2025. So we know we are most likely going to be dealing with these high interest rates than we've been traditionally used to for a little while yet. Has this affected mortgage stress figures? Well, according to the most recent data we have from back in March, there was a slight uptick in the number of mortgages past due, and no doubt since these figures were released, they would be higher yet. It is important to note that the last time interest rate figures were this high, our household debt levels were much lower. Back in 2012, debt relative to household income was 22% lower than what it is today. But as crazy as our repayments have become, I don't believe the mortgage cliff has put any stress on the property market, and Australia's largest home lender, CBA, concurs. CBA has updated its initial prediction of a 6% drop in house prices for the year to now foreseeing prices surging by 7% in 2023, citing immigration and the ongoing supply shortage. As for what's going on currently with our interest rates, being a mortgage broker, every time a lender has a rate change, I receive an email notifying me. From what I've seen, I can say that a lot of lenders have dropped their rates, specifically their fixed rates, which would suggest that they do foresee interest rates dropping in the future. On the whole, rate drops for variable rates haven't appeared as much, and when they have, it has been by a smaller amount than drops on fixed rates. As a part of my research, I like looking at consumer confidence metrics as it helps paint a picture of several things. It influences RBA rate decisions, it serves to tell us how people feel about the current state of the economy, it is correlated to consumer spending and can even be an indicator of a volatile market when it declines sharply. The ANZ Roy Morgan Consumer Confidence metric was up 0.6 points this week to 78.7, which makes it the second rise in a row. Despite the small increase to the index, it has now spent a record 27 straight weeks below the mark of 80. Consumer confidence currently sits 7.4 points below the same week a year ago and is just above the 2023 weekly average of 78.1. What this tells us is that although people have a generally doubtful outlook on what's going on with the economy, based on the last 2 weeks of data, people are expecting better times ahead. Now let's talk about something Philip Lowe brought up out of left field. The outgoing RBA governor expressed concerns about China's deteriorating economic outlook, identifying it as one of the 3 significant uncertainties facing the Australian economy. I don't know if you guys know what's going on in China right now, but it seems as though China is going through a real estate collapse. Evergrande is in debt to the tune of $408 billion and is considered to be the world's most heavily indebted property developer. In late 2021, they defaulted on this debt and in August this year filed for bankruptcy protection. And they're not the only ones. China's biggest real estate developer, Country Garden Holdings, who did $94 billion in trade last year, just missed a debt payment of $4.2 million. To put this into perspective, it would be like earning $940K per year and not being able to pay the minimum monthly amount on your credit card of $42. That is scary. You can understand why the RBA believes it necessary to monitor this situation. These debts are huge and their impacts on financial markets are significant. What we know for certain is that a large amount of our exports are used in China's real estate development industry. So this situation is definitely worth keeping an eye on. Guys, that's it for today's video. If you want a free home loan health check to find out if you're on the best rate at the moment, please feel free to contact me from the details below and I'll be happy to help you out. If you haven't already, please hit the like and subscribe button and I'll catch you guys in the next one. Thank you.